The market share of precious metals and precious metal securities in the US market, the market that I know the best, is less than 1/2 of 1%. Less than 1/2 of 1% of savings and investment assets in the United States are precious metals related. The 4-decade mean, according to JP Morgan Chase, not some old bald gold bug, JP Morgan Chase, is that the market share of precious metals and precious metals securities over the last 40 years in the US market has been 2%. Gold doesn't need to whip the US dollar. Gold doesn't need to break the treasury market. All it has to do is revert to mean. If it reverts to mean, the market share in the US market grows fourfold.
Rick Rule, a prominent gold enthusiast, veteran investor, and seasoned speculator in the precious metals and resource sector, remains highly optimistic about the future of gold and silver. He regards both metals as real money and the natural outcome of an impending collapse in the global financial system. While gold and silver experienced notable gains earlier this year, Rule anticipates even sharper price increases as the metals undergo what he terms a reversion to the mean. Rule highlights an often overlooked metric, the market share of precious metals investments in the US market. Currently, precious metals account for less than 0.5% of total savings and investment products, a significant drop from their historical mean of 2% over the past 4 decades. According to Rule, this disparity signals an imminent rebalancing. As investor interest in precious metals grows, he expects demand for gold, silver, and related investment products to quadruple, driving prices to significantly higher levels. He attributes this expected surge to growing concerns about the stability of the financial system and the enduring appeal of precious metals as a hedge against uncertainty. On Thursday, the U.S. gross national debt surpassed $36 trillion for the first time, according to data from the Treasury Department. Publicly held debt, a portion of the gross debt excluding intergovernmental obligations, has also reached record levels, exceeding $28 trillion. These developments come just 4 months after the national debt crossed the $35 trillion threshold, highlighting the pace at which borrowing continues to escalate. As Maya McGuinness, president of the Committee for a Responsible Federal Budget, noted, "We started 2024 by crossing the $34 trillion threshold, added another trillion during the summer, and now we're heading into the holidays with yet another trillion." This trend reflects ongoing government borrowing, which shows little sign of slowing. Unless policymakers enact significant reforms, the debt is expected to continue climbing by trillions of dollars in the years ahead. This is exactly why Rule's conviction in gold, silver, and other precious metals and commodities continues to grow despite recent price movements. He is certain that the rest of the investment world will catch on to this disturbing trend pretty soon, and there will be a mad dash for tangible assets like precious metals, leading to a quadrupling of demand and prices. We will present clips from Rick Rule's recent interview with Kitco News. As we do, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
The probability that Trump actually cuts spending. When you look at the range of campaign promises that he made, it's obvious that he wasn't really campaigning on cutting spending. He was campaigning perhaps on cutting spending to constituents that didn't vote for him, but that's not the same thing. If you were as old as I, and I realize you're not, you would have experienced this once before during the Reagan Revolution. Reagan came to office with a much stronger mandate than Trump to dismantle government, reduce the size. There's a wonderful book called The Triumph of Politics by David Stockman that describes the derailment of the Reagan Revolution within 180 days of them taking office. Think about empowering a government agency, the Department of Government Efficiency. Yes, you're creating a government department to reduce government departments. Think about that. The probability of them achieving that, I believe, is 0. As to your first question, how do we get out of this? I think, unfortunately, the answer to that is clear from history. We faced the same circumstance, although less dire, in the decade of the 1970s. And what we did is we honored our nominal obligations. In other words, some old codger like me, who's getting, I don't know what I get, $4,000 a month in Social Security, I'll continue to get $4,000 a month, but $4,000 won't buy $4,000. We will honor the nominal amount of our obligations, but will inflate away the net present value of the obligations. The US government themselves suggests that in the decade of the 1970s, the last time we faced this circumstance, the purchasing power of the US dollar was reduced by 75%. Not coincidentally, during that period, the gold price went from $35 an ounce to $850 an ounce. Yes, the two events were related. The only way that I understand that we get ourselves out of our debt crisis while politically honoring the nominal value of our obligations is to inflate away the net present value of those obligations. I believe, I'm not an economist, I'm a credit guy. Right. I believe, just from talking to people, that people's expectations of the future were formed over the last 40 years. Probably the easiest times in humankind. The nominal interest rate, the real interest rate were falling. The US government was able to export inflation to other countries because of our currency. Right. We had the benefit of the good parts of globalization. We had the benefits of world trade. Unfortunately, I think most of that came to a screeching halt beginning 2022. I'm struck that most people don't understand the difference between solvency and liquidity, which is to say somebody who has a $700,000 home mortgage, $100,000 in credit card debt, whatever it is, they're making $70,000 or $80,000 a year. If they have $10,000 in their jeans, they can afford today's bills. They're maybe going to lose their house. They're maybe going to go upside down in credit card debt, but today they can buy a hamburger. I would describe the circumstance that we're in today as that same thing. We're confusing liquidity, the fact that there's cash in the system, with solvency. The second thing is that we are in an economy that is doing reasonably well. It's just not doing reasonably well for most people. If you're Rick Rule and you have access to credit, credit's artificially cheap. And if you understand how to use the credit, this economy, for people like me, is spectacular. This economy, for people who don't have access to credit or don't know how to use credit, people who are more focused on their lifestyle and on their family than they are their finances, this economy is not working for them. And we need to understand that there is a human cost to the economy that we're in, irrespective of the fact that the headline numbers are pretty good.
U.S. inflation increased by 2.6% year-over-year last month, marking a rise from September's levels. This uptick comes as the Federal Reserve has begun reducing interest rates in response to earlier signs of easing inflation and a softening labor market. Core CPI, which excludes the more volatile food and energy prices, rose 0.3% in October compared to the previous month. Year-over-year, core prices increased by 3.3%, marking the third consecutive month at this level. Though these figures were in line with economists' expectations, there are concerns that they are far from the Fed's 2% inflation target, and that inflation has become sticky. Rick Rule often refers to U.S. inflation data as the CPI to highlight discrepancies between the reported Consumer Price Index, CPI, and what he considers the real inflation experienced by consumers. He argues that the government's methodology, including practices like substitution, weighting, and hedonic adjustments, understates the actual cost of living increases. Rule emphasizes that such manipulation allows governments to downplay inflation, which in turn lowers the obligations for inflation-linked expenditures such as Social Security and other entitlements. This is why he says not to trust the CPI, but the power of important safe haven assets like gold.
Gold has done a great job, and I'm delighted. Well, I'll give you some arithmetic. If I was on Adam Taggart's show and one of his readers said to me, "Rick, when is the gold price finally going to move?" I would say to that person, I'd be old and sage, it's going to move in the year 2000. In the year 2000, it was at $253 an ounce. Now it's at $2,600. In other words, it's up, what, sevenfold? Gold has increased by almost 8.5% compounded for 24 years. It's done exactly what it was supposed to do. It's protected by purchasing power for 24 years. So when you're asking me when gold going to move, 24 years ago. What I really like about it from an investment perspective is that it has this wonderful track record, which nobody cares about. The market share of precious metals and precious metal securities in the US market, the market that I know the best, is less than 0.5%. Less than 0.5% of savings and investment assets in the United States are precious metals related. The 4-decade mean, according to JP Morgan Chase, not some old bald gold bug, JP Morgan Chase, is that the market share of precious metals and precious metals securities over the last 40 years in the US market has been 2%. Gold doesn't need to whip the US dollar. Gold doesn't need to break the treasury market. All it has to do is revert to mean. If it reverts to mean, the market share in the US market grows fourfold. Now, can you imagine what a fourfold increase in demand for gold and gold stocks in a market that controls 23% of the savings and investment assets in the world would do to the gold price? I mean, you know, Bitcoin is what, a $3 trillion asset class? Robert Friedland describes that as a pimple on an elephant's ass. Yeah. And the crypto moron are very similar species. But if you look at a global market for savings and investments at the $750 trillion level, gold is a sideshow and Bitcoin is a sideshow. They don't matter. The circumstance that will cause the gold price to move is a circumstance where perhaps Bitcoin can be accommodated in the move too. My suggestion is that they serve different purposes. Right. Gold is a store of value and a medium of exchange. Bitcoin is a network and a transfer mechanism. So I think at their heart, they're different asset classes. Right now, they're regarded as momentum. They're regarded as trading vehicles. I engage in conversations here with people about Bitcoin, and I admittedly know almost nothing about it.
They must love you.
And I would suggest that I know substantially more about it than they, and they're advocates. Despite the fact that I know more about it than they do, I profess no knowledge. The real knowledge they have is that they've watched it go from 1,000 to 100,000. That's the whole knowledge. And the fact that the asset class is up 100-fold, they somehow think makes it more attractive. Let's say that your fiance went to the grocery store and the price of bananas was up 100-fold. She would be very logical and not buy bananas. But because an asset class is up 100-fold with no demonstrable change in utility,
the U.S. national debt has been growing rapidly, hitting key trillion-dollar milestones at increasingly shorter intervals. The national debt hit the $33 trillion milestone in September 2023. Just 3 months later, the debt rose by another $1 trillion. By mid-2024, the debt reached $35 trillion, growing at a rate of nearly $6 billion per day. The debt surpassed $36 trillion on Thursday, indicating that the rate of borrowing continues to accelerate. It should be noted that it took 233 years, from 1789 to 2022, for the debt to reach $31 trillion, but less than 2 years to add the next $5 trillion. Experts believe the rapid escalation emphasizes the urgent need for comprehensive fiscal reforms to address this unsustainable trajectory. Will the Donald Trump administration be able to provide the needed reforms? Let us know your thoughts in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.